Hey everyone, my name is Ilan Azbel. I'm going to be talking to you today about how I use R in trading markets. So I know in the last few months, there's been a few meetups where people have pitched products, and I just want to let you know that I'm not pitching anything. I'm not trying to sell you anything. Just kind of back to basics, just letting you know how I do things. A few people have asked what this T-shirt is about. I'm actually the chief executive of a company called Autochartist. It's a small, unknown group. It's actually based out of Johannesburg, South Africa. I'm myself and my colleague Jingwei, who's sitting at the back, also in a green shirt. We're just here in Austin, but the rest of the company is in South Africa. We sell a product for retail traders that tries to forecast the market for retail traders. It has nothing to do with what we're talking about today. I just wear the T-shirt, so it is what it is. If any of you want to get in touch with me after the meetup, or you don't have a chance to ask me questions about how I do things, I've left my business card. But again, this is not a work-related thing. This is just my experience. There's many of you which I think have maybe a lot more broad knowledge about time series forecasting than I do. Again, I have a certain level of expertise. My expertise certainly lies, I would guess, more in financial markets rather than time series forecasting, but the two go hand in hand for me. And I'll just try to show you what we do.
What's your relationship with Autochartist?
I'm the chief executive. Okay, there we go. All right, is that okay? Slide 2. All right. So, just a show of hands: has anybody ever traded? Just traded. Maybe actually, who hasn't traded? That's going to be interesting. All right. Okay. And do you all trade the traders? Do you trade stocks or futures or forex or? Okay, stocks. Who trades stocks? Okay. And futures? Forex, foreign currencies? No one. Okay, cool. All right. So I only trade foreign currencies. Interesting enough. The reason why I actually trade foreign currencies is because I find it to be a manageable set of instruments. When I moved to the US about just under 3 years ago, and I look at the available amount of instruments there are on let's say the New York Stock Exchange or NASDAQ or Amex, it's for somebody who comes from a country where I think there's about 20 or 40 liquid instruments to a country where there's like 2,000 liquid instruments. For me, I haven't wrapped my mind yet around taking all that data and actually crunching it. Jingwei will attest to the fact that I'm quite thoughtful and I try to do things from start to end. So taking on a massive data mining project like the New York Stock Exchange, for example, for me is right now is something I can't do in my life right now. So when I look at trading, and the reason I chose FX is because it creates, there's let's say 7 or 8, arguably 8 currency pairs that really form about 97, 98% of the world's currency trade. And so when you're starting to analyze 7 or 8 instruments, it becomes a lot more computationally feasible to start analyzing the stuff. Although the converse to that is that you'll find that most they're almost because there's so much liquidity and so much trade focused within those specific instruments, you find that the movement of those instruments is actually pretty much as close to random as you can get. So to find anomalies is extremely difficult. And furthermore, because foreign currencies are what they call an OTC instrument, over-the-counter instrument, you can't front run really. So let's just say an example of what an OTC instrument is, and it's important to understand this, is that I can walk up to someone and say, hey, I've got 10 pounds in my pocket. I'll give you 10 pounds, you give me $15 back, right? I don't have to go and give my 10 pounds to an exchange somewhere and then my counterpart gives it to exchange, right? There's no exchange in the middle. foreign currencies, by their very nature, are what they call over-the-counter instruments. It's an unregulated exchange, right? Which means that sometimes you don't even know who your counterparty to your trade is, right? So it's not all about execution and latency, like you get, a lot of, there's some books lately, flash traders and all the stuff that's been written lately about people front running trades and, getting, a millisecond faster onto the exchange than somebody else. In an OTC market, that kind of thing plays less of a role. So that also creates an interesting dynamic. So for those of you that have never traded before, what you see in front of you is really a chart of, I chose euro dollar, and that's the example I'm going to be working on today, euro dollar. The little chart on the left is just a snapshot I took from Yahoo Finance of the day's trade at euro dollar. And I guess the next slide, I just want to talk about, just some terminology so that the people that have never traded before understand what I'm talking about. So those of you who have traded, just bear with me for like 5 minutes until I bring everyone up to the same level. So in financial markets, if you look at, let's say, every trade that's happened on the market, and you see the little chart on the left, that little trade just for a few hours has, literally had tens of thousands, if not hundreds of thousands of trades. And so sometimes it's difficult to visualize and to understand, to compute such a massive amount of data. And so what people in the financial world have done, correctly or incorrectly, it's a question of convenience, is created this concept of what they call a candle, which is really a summary of a whole bunch of movement, right? So if you look at the picture on the left-hand side, that is a candle, and what it basically depicts is a range of movement within a certain period of time. Okay, so let me walk up to that candle actually and show you what I mean. So open is where this candle started. That was the first trade that happened for a certain period of time. Close is where the last trade happened for the period of time. And then there's a high and there's a low. There's an upper shadow or lower shadow, or the upper wick or the lower wick. And so this creates like this candle. I mean, it looks like a candle. And so for convenience sake, people have created these green candles and red candles, which depicts an upward movement within a certain period of time or a downward movement within a certain period of time. But really, the way to look at these things, it's just a tool for visualization and in a way to summarize data. So that's one piece of terminology that you need to kind of be aware of. And I don't want to spend too much time. I hope kind of everyone got the basic gist of what I was trying to say. Then the next thing is two different types of trading, which is trading long and trading short. Now, trading long is what we all conceivably understand. It's we buy low and we sell high, right? We buy a stock for $1 and we sell it for $1.10, and we've made 10% on our money. Okay, so that's great. That's an easy one. So does anyone want to stand up and volunteer to explain how you trade short?
No. You sell something or you have it, you borrow it, then you have to buy it back later.
Okay, so let's say this gentleman over here. Sorry, what is your name? Peter. Peter has got some Apple stock, right? And I think that Apple is going to go down, right? So what I do, and I say, hey Peter, listen, can I borrow your Apple stock for a couple of days? Okay. So Peter gives me his Apple stock, and I pay him. Let's just say Apple's at $100, right? So I give him $100 for his Apple stock, right? All I owe Peter is Apple stock. Okay. So I'm sitting with some Apple stock, right? So now I go into the market and I sell it to someone who wants to buy it, and I sell the Apple stock, and now at the same time I've got $100, and the Apple stock goes up. Let's say it goes down. So I'll make it easy. It goes down to $90, right? I think, it's gone down to $90. I'll go back to the person that I sold it to at 100. I say, I'll buy it back from you for 90. Okay, this guy's panicking. He wants to get out of the market. He thinks Apple's tanking, right? He sells it back to me for 90. Right? So I give him 90. I'm now up $10. And all I do is I give Peter his shares back, right? Because I just lent it from him. So I'm up $10. I'm up 10%. So that's the way you can actually don't have to trade only buy short, buy cheap and sell expensive. You can also sell expensive and buy cheap to make money the other way. And it's slightly more expensive to do that on the stock market, but in the Forex market, it's much easier because you're always trading an instrument, right? So if I'm sitting in cash, right, in my pocket, I'm sitting in US dollars, right? I'm always trading one instrument against the next. So if I'm buying euro dollar, I think euro is going up and dollar is going down. If I'm selling euro dollar, I think dollar is going up and euro is going down. So it's, you know, it's really just the inverse of each other. But essentially the concept is you can trade up or you can trade down. Okay, so now I've spent enough time on that nonsense. Okay, so now what I'm going to do today is I'm not going to, you know, show you how to forecast the market. I'm not going to give you the secret sauce. I'm just going to walk through two very simple examples that Jingwei and I put together over the last few days, just to show you the kind of thing that we do, the kind of thing that we analyze. A few of you, I had some conversations before this. A few of you are asking me some really difficult questions about, you know, other industries and stuff. And, you know, I have a vague understanding of, well, I wouldn't say vague. I have a certain amount of depth of understanding of time series forecasting, but I wouldn't say I'm an expert. You know, if any of you are looking for kind of I would say the de facto standard in R for doing time series forecasting, which takes into account seasonality. I think it's a Professor Hindman. I don't know if any of you are aware of this package. It's called the Forecast Package. Just look for the vignette on Google. It's called R Forecast Package, and you'll find it. It's got a lot of pretty good seasonal analysis type stuff. But that's not what we're going to do today. Because when you use that package to forecast the market, you literally get a 50% chance of going sideways with a normal probability on the end of it. So it's pretty useless for doing that. Okay. All right, example one. So my first example is going to be very simple. My next example is going to be slightly more complex. And the second example, I'll actually take it into a trading environment and actually back test it and forward test it and show you how I do things. But the first example is very simple. And this we're going to leverage on that knowledge of the candles, the up candles and the down candles. So it's a very simple question. Having X consecutive bullish candles or bearish candles, what is the probability of the next candle being up or down, right? So you all know the whole thing in statistics, stats. It's even before 101, right? Is that you flip a coin 10 times and it's heads all the time. What is the probability of the next one being heads? It's 50-50, right? Doesn't matter if it was 10 times before, right? So the question is really, is there any way are there any dynamics in the market that actually give us an edge to actually try predict the market using those examples? And so what I've tried to illustrate with those arrows, and it's not very clear, but so for example, let's say there's 3 green candles. That's 3 green candles. What's the probability of a red candle afterwards? See, 3 green candles, a red candle, 3 green candles, and a red candle. So that's the kind of thing. It's just a hypothesis. You know, let's test it and see, you know, and see what happens. So if you bear with me for just a moment, what I'm going to do is I'm going to switch to my R Studio, if I can figure out how to do that. Yeah, cool. All right. Okay. There's the first part of this example that I'm not going to run here because it takes like 5 minutes to run. So I'll just tell you what I did. I have some sample data sitting on my hard drive. It's euro dollar 60-minute candles. That means I'm analyzing 60-minute movements of euro dollar. Literally chose it at random. There's no reason for it. It's just people understand an hour. If I said it's 7-minute candles, then you'd probably ask me why 7, you know, but people understand hours, so I chose hours. Okay. And what I did was I created some some data that basically looks at consecutive candles. So I'll just show you a bit of that data. So this column over here tells you whether it's a bullish candle, meaning it's an upward candle, a green one, and if it's so 0 means it's a red candle going down, and 1 means it's a bullish candle going up. And so what you see here is I've got a little counter variable where I've got, you see, this is a downward candle, downward, downward, downward. So there's 1, 2, 3, 4 consecutive downward candles, and then a bullish candle, right? And then, one bullish candle, one, 2, and then a change of direction. And so I created that. I didn't run it now in front of you because it takes a bit of time to run. So I'll just skip that bit. But this, from here on out, I'm gonna kind of run it step by step. So I create another candle, another column where I just create what the next candle is, just some pre-processing. And then I create a table of what actually happened. So this is the candle versus what the next candle was. So it shows you here that this is, for example, let's say about 15,000 candles. When we had one candle, one bullish candle, the next candle was bearish, right? Which means that it's almost 50-50. It looks like there's a slight bias towards bullish candles than bearish candles. So, and what you will notice is that, in fact, it's difficult to add those numbers up. So what you will notice is I'll actually just run a percentile table here. Oh, that didn't display very well. There it is. Okay. So what you will notice is that the lower you go down, the more consecutive candles you have, right? The more probability there is of actually a turnaround, right? The next candle being the other way. So, for example, when you get down to what I think I chose 7 for this example, 6 or 7, there's almost 8 consecutive candles. There's a high probability, and a 0.65 probability of the next candle being the other direction. Okay, so if we wait long enough to be a lot of consecutive candles, then we should trade the other way, right? Which is an interesting hypothesis. So let's see where that goes.
Is this done on historical data?
Yes, this is historical data.
Going back how far?
Oh, this is the data set is 2010 till 2014.
Okay.
Yeah, it's quite a big data set. Okay. So actually, I'm going to spoil the I won't spoil it. I'll just keep going. Okay, so next thing what I do is I just create more columns just to make my calculations easier when I would open, when I would close. I'm not looking at any market conditions at the moment, like slippage, not being able to open or close at the certain price that I wanted. All I'm doing right now is, and this is what we do at the office, is we test hypotheses first within R, and then once we have a hypothesis that seems to work, then you'll see in my next example, we actually put it into a trading and backtesting environment. We actually rigorously test the entries and the exits out of the market. But for now, I'm just trying to show you how we look at the market and how we test things within R to create these hypotheses. Okay, right. So now what I do is I chose 7 in this example. So if there's 7 consecutive candles in one direction, I want to trade the other way. Blah, 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 this doesn't matter. Now, this is a very important line. I'm setting my trading costs to 0. That means I can get in at the price that I want and out at the price that I want, right? There's no trading cost at all for me. So I create some profit, some balance, and it looks like we're going to be gazillionaires, which is awesome. Go home and start trading. Okay, so obviously this is tested. This is a test on the data on which I modeled it, right? So it's it's a bit messed up. Okay, okay, it's like a self-fulfilling prophecy. But it gets even worse than that actually, because as soon as I set my trading cost to 2 points, and I won't go into what a point is, then I'm market neutral. So which really sucks. So I'm kind of making money, losing money, in fact, I end up losing money. And I mean, if you think about that, I'm losing money on the data on which I modeled the thing. So you can guess what happens with this hypothesis, right? It gets tanked in the trash can, and we move on, to our next example. Okay. So yes.
Is 2 basis points kind of considered to be the average for this type of trading? You said 2 basis points was where you kind of
Yes, yeah. Well, we're going into other areas, but
it varies depending on what broker.
It varies depending on broker and how much you trade. So when we trade our own book, we trade at 1/10 of that. So it all really depends. But most retail traders, if you're trading, let's say, less than $500,000, you're looking at somewhere of that kind of region. Yeah. So, and also, it's not only it's not only a matter of cost. It's slightly. Sorry, I'll just spend a minute answering the question. It's actually not only a matter of cost. Actually, in the market, there's something called slippage as well, which is, let's say, I want to buy euro dollar at a certain price, and then it's just not available in that market at that price, right? Someone's selling it higher or lower, or whatever it is. And normally, what I like to do when I model entries and exits out of the market is I do like to build in a slippage over and above my cost, because that's important. If you're trading a very small amount, let's say you're trading $10 to $100,000 of exposure on the market, like really, really small amounts, then you can assume no slippage because you're in and out. But if you're starting to trade higher volumes, then the problem actually gets it compounds, because what happens is you can get in a portion of your trade at one price and another portion at a higher price. You kind of have to look at the average price that you get in. But normally I like to build in some kind of error margin into it. So. Okay, all right.
Question about this. What's on the x-axis? Is that the number of trades?
Oh, sorry, that's the trade number. Yeah, the trade number. Sorry, I should have said that. Yeah, that's the trade number, and that's the amount. Yeah. Okay. So what I want to do next is I want to quickly flip back to my PowerPoint presentation. Do you mind if I just keep it like this? Is that okay? Instead of making it full screen, it's just one slide. I want to show you. So in this example, I'm going to get slightly more complex, and this one's actually going to end up in a trading environment where I'm actually back testing and forward testing. So the hypothesis here is euro dollar cyclical? Okay, and what we're going to do is we're going to come up with a very simple concept to test cyclicality. So what we're going to do is we're gonna smooth out the price graph, right? We're gonna find some turning points where the price turns, and then we're gonna measure cyclicality according to time between the turning points and cyclicality according to price movement. Okay. So we're going to be measuring cyclicality according to those two axes.
Do all of this in that R software?
Yes, I'm going to do this in R. And if you all want the code, I said in the little chat, people will ask me for code. I'll just post this code with the comments that I have, along with some sample data, and you guys can play with it. Just excuse the spelling mistakes if there are in my comments. We're just kind of preparing this thing. So I'm just going to switch back to my R studio. Okay, so this is the second example, cyclicality. So this is something which is very critical when it comes to what I found is important when it comes to analyzing time series data. What's helped me a lot is making my x-axis uniform. Okay, now the reason why I do that in the financial market space is because if you work with an x-axis that's a date time, what you're doing is you're distorting your market movements when it comes to weekends. Okay, so it adds these straight lines and basically flat markets on the weekends, and that really distorts the analysis. So what I normally do when I'm analyzing, again, this is specific to my domain, right? In financial market data series, so is I completely ignore the date times. I actually just normalize, and that's exactly what I've done here. I've literally just added a. Can you guys actually see that code? I wonder. What I've done is, I'll just tell you, is I've just added a row number. 1, 2, 3, 4, 5, 6, and that's what I'm going to use as my x-axis instead of using a date time, because I don't want that distortion. And then what I'm just going to do is I'm just going to do a very simple kernel regression. I think that the default is a Gaussian kernel, and this is I've just taken the first 200 points of price data, and here is the smoothed out curve in red. But obviously that's just the first 200 points, right? The first 200 hours of trade. Obviously this goes over 4 years, so there's a lot of data which won't fit in there. So I've just wanted to show you how we can just smooth out the thing. Again, all the numbers here at this presentation are random. You guys can take the source code and do what you want. I chose a bandwidth of 10. If you guys know anything about regression, that's basically just the sensitivity to noise. The bigger the number, the less sensitivity is to noise. I wanted to kind of pick up these kind of small movements. Yeah, again, completely arbitrary. I literally just started typing numbers. So, and then what I do is I find I wrote some code to find some peaks, some troughs, and then I'll show you what that looks like. Okay, so there's some. Can you all see that there's red dots where I found the peaks and green dots where I find the troughs. And so what I've got essentially here is a simpler version of what I'm trying to analyze, right? Yes, it does contain a bit of noise, but certainly not to any degree of the kind of noise you really do get in the financial markets, right? And so I'm now going to, as a next step, test the cyclicality of that. So I'm just going to create some distributions to show you. Okay, candle difference versus price difference. So the x-axis here is the difference in price between each of the turning points, right? And the y-axis is the difference in candles. Actually, it should have been the other way around, right? Because candles go this way and price go this way, but it doesn't matter. Okay, you can see that certainly the majority of the cycles happen, I guess below 20, 30 or so candles. So that gives us an idea of, there's a clear, distinct cluster there, right? So it gives us an idea that euro dollar, the turning points are very, clustered around, less than 30 candles.
Not as volatile.
Sorry?
It's not as volatile.
No. It just the turning points, right? The significant turning points of euro dollar happen within 30 hours. Okay, which is yeah, it's a number. Okay, and then similarly speaking, the price difference, right? The amount it moves, right, within those 30 candles, so is certain less than this is 100 basis points. Sorry, 100 basis points. So we can immediately see that certainly there's something already before even backtesting this. There's something there we need to take advantage of. Now there are many different ways of trading this type of thing. You can try forecast when the next turning point is going to be to trade that. I'm going to, for this example, I'm going to be a little bit kind of extreme and make it a slightly more difficult problem. What I'm going to do is, if we look at the screenshot, is that I want to explain. I've split the graph up into 4 quadrants really, and I put the main cluster over here on the bottom left. So this is where, and again, I kind of drew these I didn't do any stats around drawing these lines. I just kind of looked at the picture, actually printed it out, and drew some lines with a ruler. You all can play with the code and do with it as you wish. So over here, this is normal business. So I'm actually, for this example, I'm not interested in normal trade. I want to do something a little bit different for this example. If you look at this quadrant over here, this is very little movement over a long period of time, flat markets, right? This quadrant here is again proportional, a lot of movements over a lot of candles, right? So again, I'm not interested in this. Now this quadrant over here, this quadrant over here for me is quite interesting because this quadrant is a lot of movement over a short space of time. So that's quite interesting for me because I look at something like this and say, okay, this is a mean reversion opportunity, right? I think it's moved too far, too fast. I think it's going to come back, all right, to kind of normal trading cycles. And so the example I've built is around trading this. If something has gone up too far and too fast, trade the other way. It's what we call mean reversion trading. Okay. All right. Okay. So now what I did. So I'm looking at my comments as I'm doing this presentation to see what I did. So what I did is I essentially took these 2 lines and I worked out the percentiles for both the candle difference as well as the price difference. And actually, am I printing them out here somewhere? Oh, I actually haven't. Oh yeah, I'm printing them out. And what I'm doing is I'm actually showing you where they are in terms of distribution of movement, right? So this is for the price difference. You can see the vast majority of the prices within the cycles are over here. Obviously, it's not a long tail, but just this kind of distribution. And the line that I drew, the red line that I drew, this is where it lies within this kind of histogram. I guess it's just for information. So just to show you, it works out to be, what does it work out to be? Somewhere like 80th or 90th percentile, basically, of movement. And similarly, for the candles, if you recall, it was somewhere around 30 or so. I drew my line, 30, 40, and it ended up being about 34, 35, whatever it was. And just to show you what the distribution is of the candles. And you can see quite clearly that certainly the majority of cycles of euro-dollar happen between kind of 10 to 20 candles. Sure. Are we all falling asleep yet? Okay, we're getting to the interesting bit now. Okay, so now what I want to do is I'm just going to just run some code to set up my trades. You all can go through this at your own pace if you want to at home, and so if that's what you do at home for fun. Okay, so now I basically drew that same kind of equity graph based on this theory, right? So if it goes out too far, trade the other way, and if it right, so whether it's going up or down, if it goes up too much too quickly, I trade short, and if it goes down too much too quickly, I trade the other way. And so I set my cost to 0, right, the killer, and I look at it, and I'm like, oh, okay, I'm cautiously optimistic, as I put it. And then I set my trade cost to 2 pips, which is plenty. And did that move? Right, yes, actually it did move. So you can see the profit there is above 4. So it moved it. Okay. So we're on to something. Even with the cost of 2 pips, there's something here. Okay, so now what I would typically do is I would say, okay, this hypothesis gets upgraded. We can go to the next level. We can actually test this thing out in in real market conditions. Can anyone guess what the problem is with this hypothesis? Sorry? No?
Well, it's not related to world events or anything going on.
Okay. Is there anything statistically at fault here with this? Can anyone? It's an unfair question of me to ask you, but let me show you something. I want to show you guys something interesting.
You're looking for velocity. Velocity is bad. Make a change if you have velocity.
Right. So now let's velocity is bad. But now have a look at what we did. If you recall, I kind of skipped over it on purpose because I didn't want to ring any alarm bells. But I used a regression to fit this to smooth it. Right. I used the regression. Now, as you add data points to the end of the series, the regression line changes backwards, right? It's not like I worked out the point, this value in the regression, and that's the way it stays forever, right? So if I add more points over here, this turning point could go away, and so could that one, right? Because the regression line suddenly smooths it out, right? So the question is, yeah, it's all nice in hindsight, right? Hindsight is 20/20, as we say in the financial markets, because you can actually fit your curve. You know what happened, all right? So your regression line takes into account what happened in the future. But when you're actually trading real time, right, going forward, your regression line keeps changing. So you might make let's say I place a trade based on this turning point here. 5 more data points from here, that turning point could completely disappear, might not exist anymore. In which case, oh crap, I'm in the market. But the reason I'm in the market has just disappeared, right? It's like someone pulling the carpet out from under you.
Can you forward test on the system?
No, so this is what I'm going to get to now. So, okay, so now actually, I haven't even opened up my trading platform. All right, so this is really, I guess, up to here is where I kind of step away from R and start moving on to a more sophisticated backtesting and forward execution platform. So let me just close down some trading stuff. I'm just going to open up a little example that I wrote for this this presentation. So I guess I'll just spend a minute explaining why I walk away from R at this point in terms of doing forward backtesting and forward execution. If you want to do very, very basic backtesting and forward testing, there's a few packages out there. You can use QuantLib, I think. There's 1 or 2 other time series packages you can use. But there are quite major drawbacks. They're only good enough for cursory evaluation. I think the purpose of this presentation is for me to show you how we use R in our real-time actual trading environment. So that's what I wanted to do. For example, when you're using R to, let's say QuantLib to do backtesting or forward testing, you can trade 1 instrument at a time. If you want to trade multiple instruments at a time and know your equity value or your cash value at any point in time and make trading decisions about your available cash at any point in time, these kind of event-driven market-specific, financial market-specific type parameters, they're very difficult to model in R. And so what we do as a company is we build hypotheses, we test hypotheses up to a certain depth in R, and then we move on to something more sophisticated from a backtesting and forward execution perspective. So I use this company Sear Trading. Anyway, they don't do business in the US. They're quite big in the UK with a lot of hedge funds in the UK, but a little known company, very niche boutique product. And one of the reasons why I use them, and this is what we're getting to, is actually it gives me the ability to literally copy and paste R code into my trading terminal. So I don't need to ask C developers to redevelop the regression and spend 6 months debugging the modeling stuff. I can go straight from, well, almost straight from modeling to testing, and not get bogged down on debugging, a bad code, and so I'll spare you the details, but essentially what I've done is I've copied and pasted, other than the first 2 lines. Other than those 2 lines, which is basically getting data from this SEER environment and just putting it into a data frame. Other than that, the rest of this code that I'm highlighting here is literally a copy and paste of the code I had in my RStudio. And you can see I've even commented out the ggplots and all those plots. It's literally a copy and paste. And that's the kind of thing I like to do, because that gives me the ability to look at this thing and say, yeah, oh, that works great, or I have to change a few things, go back into R, remodel, test, paste it back into SEER, and but essentially what we're doing here, which is I think the basis of the presentation, is this is how we use R in a real-time trading environment, okay, well, yeah, and so what we do is, I mean, again, I won't bore you with the details, but essentially R produces some values. It produces, in this situation, the candle diff and the price diff. So it's basically telling me when a certain amount of candles have been exceeded, or it's moved a certain amount in terms of price, trade, right? So all my analytics and everything is sitting in R, and then it just spits out a decision. Oh, let me go to the very top. And what I'm doing here is this first line is very important, because what I want to do is I don't want to recalculate a regression every single time I get a candle and move a piece of data in. So what I'm doing is I'm recalculating every recalculation period. I think it was like 120 hours or whatever. So like every week I do a new regression, I remodel, and I put new parameters. So that is very, very important. And you find a lot of, if any of you trade, you find a lot of kind of more amateur quants that what they do is they create a model, they overfit, the model works for a month, and then the whole thing just collapses, okay? And then everyone loses their money, everyone's sad. Why? Because they don't adapt, right? So what I like to do is I like to leverage your computational power, which is the reason why I have computers, and actually try and change the model as we go along. And so I'll actually show you when I backtest this how the model actually changes. And these are the percentiles. So remember those histograms I showed you? So on the price difference it was 87 percentile, and on the candle difference it was a 91 percentile. And I'll show you how the actual numbers change. And yeah.
Did you run any analysis to figure out how many hours you wanted?
No, I literally ran nothing.
Just kind of had that feel.
Dude, it was just like literally, you can ask Jingwei, we sat at the laptop and we just punched some numbers in, we drew some lines manually. Yeah, so yeah. I'm not giving you the answer. If you want the answer, you can invest in my hedge fund.
It seems like it could be a difference in a lot of money, just running an analysis.
Absolutely huge.
Should it be 200?
Yeah, people ask me. People think that actually there's this perception in the market that you build an algo, you build an automated trading strategy, and then you retire and you sit in the Bahamas and you chill out. Actually, it's completely the opposite, because a 0.01% improvement in your performance could potentially mean a massive amount of money. So there's constantly work going in. No one's sitting in the Bahamas and chilling out. I can promise you that. So, but yeah, you're right. Everyone's always constantly tweaking and doing things. Yeah. I'm not going to kind of bore you with the details. Essentially, this piece of code here buys when it's gone up, or sells sells when it's gone too high, and buys when it's gone too low. Okay. Now, for the purposes of this presentation, I've kept things really simple. Once I enter a position, I'm going to be super greedy, and I'm not going to exit the position until I'm in profit. Okay, so I'm Superman. I feel like I'm Superman.
How much profit?
Oh, I put it down as $5. If I'm up $5, I'm exiting. I'm getting the hell out of there. Okay, so cool. So let me try and move this screen sharing window. I'm going to just set I've got a back test here, and I'm going to run this back test. I want to see what happens. It might be a little slow because I'm screen sharing. Okay, it's not too bad. Okay, we're running through. I think it's 4 years of data again, and I think this is the data on which I modeled, right? So we're expecting pretty good results. Okay, so here are some results. We made 6% per annum, and our drawdown was 56%. So it's absolutely shocking. But this is what our trade equity curve looks like. Okay, I don't use a trade equity curve. I use what they call a mark-to-market equity curve. So a trade equity curve tells you the amount of money you had when you opened the trade and the amount of money when you closed the trade. It doesn't tell you anything about what happened in the middle. So let me show you now what really happened in the middle so we can evaluate whether this is a good system or not. So I'm just going to, okay, so this is what really happens, which the trade equity curve doesn't show you. Looks like we're making great money. And then this is the break-even line over here. And then at some point, the whole thing goes for an absolute ball of crap. Okay, and then it happens to recover again, right? And so that's what's missing from a trade equity curve. So it's important, and this is the kind of thing that's very difficult to model within R itself, right? To actually understand what your cash position is at any point in time. Okay, so it's very important to look at the actual mark-to-market equity curve and your cash position at any point in time. But now that the price goes up and up and up, and there's a few of these kind of major dips, and so, well, it's, certainly this is worth looking at a little bit more, some more dips, etc. Okay, so I look at something like this and I say, okay, back tested, not bad. There's clearly a problem, right? I'm holding the positions too long, and that I understand because that's purely a matter of the fact that I'm holding my position until I'm in profit, right? So I'm holding losses forever, right? And that's why I'm losing all my money. Okay, so there's clearly a problem with my exit strategy, right? I need to set some kind of what they call a stop loss when I've lost too much money, get the hell out of the market. And then what I can do is I can actually forward test it. Actually, what I wanted to show you first is, so before I forward test it, I want to show you this, is that you can actually see how my parameters change. So remember, we started off with like 30 odd candles and a certain amount of price difference. And that's on the top line, right? We start off at 34 and 0.016 as a price difference. And as the thing readjusts itself, right, we end up at, 32 and 0.008. So the cyclicality, as we've moved through time, the cyclicality of the euro dollar has actually changed. And because we've had R embedded into our trading system, we were actually able to, in real time, supposedly, readjust our trading strategy to take into account the new cyclical characteristics of euro dollar. Okay, and then sorry to disappoint you all. And here is the forward test for this. Okay, we just lose everything. Okay, but the reason for that is actually I did some analysis on it. It's not because the model breaks down, and I'll show you the trading chart. Sorry, I'm just throwing a lot of charts at you. So we lose an insane amount of money because in 2014, when I forward test 2014 through to 2015, the last trade we did was over here at the start of 2014. And the rest of the time, we were just holding our position, hoping and praying that we'd be in profit. So again, it's not I don't think this is a breakdown in the model that I've presented to you. I think it's just because that wasn't the purpose of this thing, to build a winning trading system. So the exit strategy needs some work, certainly. I'll send you guys the code. You can mess around with it as much as you want, put in an exit strategy, see where it takes you. Certainly, it'll get you going. Sorry? Yes, I was long. Exactly. Yeah, I was long. And then Yeah, exactly. So it's easy to put in exactly. The trick with putting exits in is that what you don't want to do is you want to give yourself some room to be able to take into account the market noise, but yet not enough room that you incur too many losses, right? So it's like a very tricky balancing act. But
You need attention strategy as well, right? You need zero and jump back in.
yes, that's right. You need to jump back in at some point, and So anyway, yeah. So anyway, this is what I wanted to show you. This is how we use it, and what we do is we actually literally take our code and we embed it into our actual running, executing algos. And we do this on the modeling side. This is a Windows package. Actually, our actual real money that we trade runs on Linux servers. So that's R in a Linux environment embedded inside this kind of wrapper. So.
Elaborating on that system, just a tiny bit more.
Which system?
The Linux system. Like how would you say real-time operating on that?
Yeah.
What does that look like?
Yeah. So what we've done is this SEER platform, and again, I'm kind of tech dangerous. I don't know a lot of tech, but a little bit of tech. Basically, the way it's described to me is that there's like a shared memory space between R and the SEER platform, and what they do is they interchange data to itself. So it's really fast for SEER to take ticks and trades and candles and pass them to R. Let R do some analysis on it, spits results back into SEER, and then SEER makes the trading decisions. And then that happens, both. I said Linux because I'm showing you a Windows platform, but in a real server-based environment, it looks very different. There aren't pretty pictures and stuff, so yeah.
You mentioned the candle was 1 hour, right?
Yeah.
You're trading, real life trading, how's it?
Yeah, we have a range. We have down from 1 minute all the way through to daily. We have a range. So and also I'm only trading a euro dollar. I can add. This is one of the beauties of being able to use a system which is built around trading. I can, let's say, add in another. I'll just set it to backtest so we can actually see. I can actually add in, just by adding in another instrument to my portfolio, I can backtest 2 instruments at the same time, right? And then what's actually going to happen is that because SEER is smart, it keeps its own context for each instrument. You can imagine that my cyclicality analysis will be done for the pound dollar. I'll have one set of cycles, and euro dollar another set of cycles, right? So I can quite easily use the same rationale to trade multiple instruments, and that's something that we do. We trade our funds trade somewhere between 4 and 8 different instruments at the same time because we want to manage our risk. We're more focused on risk management than returns, but depending on who you are. So yeah.
Counting the number of bullish and bearish candlesticks gives you some probability of it going up or down, but it doesn't yet give you any indication whether you should go in or the examples you showed.
Yeah.
Did you use 50% as probability to make a decision, or?
Actually, we used for the first example we used a 65% probability. Yeah, but actually I didn't show you. I didn't take this thing for the first example all the way to this trading environment because when you go down to that level of probability of waiting for, I think it was 7 consecutive candles, up or down candles, I think you were trading like once a month or something. So it's just, it's great to have numbers and probabilities, but in real life, you're just missing a lot of opportunities throughout the day. And so it's not something that I would even consider, it's simply theoretical. It's not something I would consider from a real world trading perspective. If any of you got any more questions, you can come up afterwards. I've got my business card here. If you're too shy to ask me questions, you can just drop me an email or LinkedIn me or whatever you guys want to do. Cool. Thanks, everyone.